Live. Hello, everybody. Welcome to the Shock Saturday live class, beginner class. This is going to be a review going over all of the beginning lessons that we did from section 1. So if you didn't get a chance to catch those lessons, this is a perfect time to jump in, catch up. I'm going to go over pretty much what I believe to be the most pertinent highlights from this first section, things that I feel like is going to help you the most on your investment and trading journey. And then we're going to go ahead and have the section 1 test be put out this weekend for you to take and participate in, and we will be moving on to section 2 after that. All right, looking forward to that. Amp it up a little bit, but we know got to cover the basics. Got to make sure the basics are covered before you start moving on. A lot of people want to move on to more advanced topics and stuff really quickly, but you never really got a grasp on the basics. So that's why we're here. Let me share the space really quick. If you're in here now on TikTok, make sure you share the space. And you go ahead and share this out really quick on Twitter and Facebook and all that good stuff. Let me get the first few people in here. I'll get this class started. Shared out. All right, so I want to start off talking about the basics of how to buy and sell stocks. That was one of the first lessons I went over with you guys, how to buy and sell stocks. It's something that you have to know if you're going to be entering investments on any platform. So those are some basics we're going to go over right now. I just want to share this out, space out one more time. There we go. Am I logged into LinkedIn? If I am, I'll share it. Okay. Let's shoot it out. All right, all the sharing is done. Good old social media work. Hate it, but love it at the same time because it allows me to connect and share all this information with y'all. But how to buy and sell stocks. Let's start off with the basics. Like I said, welcome again, everybody. Michael Clark here, owner of Culture Shock Investments, and we are going to do section 1 review today of all of our beginner lessons. Get the section 1 reviewing, and then we can move on to the section 1 quiz, and then we can go on to section 2, some more advanced concepts and strategies for you to apply to your investing. First thing you got to know, basically, what you're using is a brokerage account. So if anybody asks you what you're using to invest, you're using a brokerage account. This is what allows you to buy and sell stock securities. A brokerage used to be a place where people would have to go. You used to have stock brokers. You know, you had people that you had to serve as an intermediary, where you go and you tell them what stocks you want to buy for the day or for the week or the month. And then they will go in and submit the orders for you through their brokerage, because they're a licensed brokerage. They'll submit your buy and sell orders the proper way to make sure that it's entered properly and you actually have ownership of your stock. Now all that is digitized. So a brokerage account is all that digitized. That's your E-Trade, Webull, Robinhood accounts. Those are brokerages. That's just a bridge between you and the stock market. That's how your money gets to the stock market and how your money gets from the stock market back to you. Now, the accounts that you're going to be using, you're most likely going to be using a standard taxable account. A standard taxable account has no restrictions on its withdrawals. Your capital gains are taxed accordingly based on your purchase time, the sell time. And it's good if this is an account you're going to be using if you're an active or investor or trader. Now, Most people that start off are going to be pretty active because they're going to be looking at your account every day, trying to make moves, trying to add money to your account. It contains under what? Reproduce content. Who said my content reproduce? That's crazy. I don't think I'm live right now. I'm live right now. They trying me. Peeling that. But who came in here and started hating this early? Anyway, someone tried to say it's pre-recorded. This is not pre-recorded. We are live, okay? Live and direct. Make sure you comment if you have questions and ask questions in the chat. Like and share the chat as well. But like I was saying, you're going to be most likely using a standard taxable account, which is going to have no restrictions on your withdrawals, your capital gains, unlike retirement accounts, which is going to give you kind of restrictions on your withdrawals. You're only going to be able to withdraw after a certain age. But retirement accounts are good for certain things like tax deferral, and it gives you better tax advantages versus you constantly having to withdraw your money and pay that 20 to 30% capital gains tax on your short-term gains. That's where the long-term portfolio comes into play in these retirement accounts. Margin account is not recommended for beginners, so we're not going to touch on that, but that's something you can get into later in your option trading, okay? I said Robinhood, Webull, E-Trade are different platforms you can use. A ticker symbol, well, I want to go back to that. E-Trade, TD Ameritrade, they're a little more advanced platforms, but if you're a beginner, Robinhood and Webull are most user-friendly. So my beginners out there, make sure you check out those two platforms. We will go ahead and talk about symbols. The ticker symbols, what you're going to see, that's going to pretty much describe, it's going to be the shorthand name of the stock. So if you got a stock like Nike, they'll put NKE instead of the full name of the stock. Tesla, TSLA. So you have to know your ticker symbols. Whatever companies you're trading, you have to know the ticker symbols. You have to know what they are in regards to what they are related to, what company they relate to, because there's symbols out there that are pretty similar, so you got to be careful and know that you're investing in the proper company, because some companies have 2-3 different versions of their stock, of their ticker out there. So you'll have, like Google has Class A and Class C shares, so you want to make sure you're buying the proper version of Google that you want to be invested in. Okay, bid and ask price, not going to go too deep into that. That's if you're diving deeper into the option trading. But you do want to know a market order from a limit order. When you're placing orders and options, you're going to quickly see, when you go in there, you're going to see market orders and you're going to see limit orders. You want to place a market order if you want to buy that contract at whatever price the ask price is on that. So it's usually going to be on the higher end of the scale where you're going to end up buying in on that contract if you choose market. If you choose a limit order, you get to choose the exact price you want to buy in at, and when the option contract or stock comes down to that level, it'll automatically trigger the buy order for you. So if you wanted to buy Apple at, let's say, $250 and it's at $255 right now, as soon as it comes down to $250, if you have a limit order in, it will buy for you. If you have a market order in, it's going to buy it at $255 immediately. Stop loss orders are important. This is going to be for people who are doing more active trading with options. So when you get into that, you're going to have to learn how to place stop loss orders. But as a beginner, you really just need to understand market and limit orders, the difference between those two. And you got to understand your price level. So the stop loss order is not such a big thing if you're buying shares on a company. You're more likely going to need to have a certain price level you're watching to hold that support, but you're not going to have to put a stop loss in unless you're trading penny stocks or something that's very volatile. But we're not doing that as a beginner. You guys are going to be investing in safer blue chip companies that have more predictable price movement. So you're not going to need a stop loss until you get into more advanced option tradings that we're getting to in section 2 I'll start talking about. All right, so we'll go ahead. That was section 1, how to buy and sell stocks. We'll go ahead. That was lesson 1. We'll go into lesson 2 now, review. understanding the major stock indexes. So if you have major indexes out there, do you know any off the top of your head? You should think about that for a second. There are three main ones out there that everybody should know if you're getting into the market, and that is, well, let me tell you what a stock market index is. These are indexes are like ETFs. These are exchange traded funds that track the overall performance of a particular sector or a particular area of the market or the overall market. All right, so the major indexes, you got the S&P 500, you got the NASDAQ, and you have the Dow Jones. S&P 500, 500 of the U.S. publicly, 500 of the largest U.S. publicly traded companies. Dow Jones is more blue chip focused. It's the 30 large blue chip U.S. companies. They're your staple companies like your McDonald's. You have your McDonald's. You have Apple in there. You have your staple banks in there. So that you go into the Dow Jones, you're gonna see a lot of those companies that when you hear those company names, you know that represents America right there. This is not organized the same way as S&P 500. This has more of a weighted. The stocks with higher prices have higher weight or more impact on this index. That's not always the case with every index. Some indexes have companies that have higher prices than others, but the market cap of that company that has a lower price may be higher, so it has more weight on that index. So like you have an Nvidia right now, that's like about 9% of the triple Qs. It's not because the stock price is the highest, it's because of the market cap of the company, how large the company is. All right, and that's taking up a lot of the weight in that portfolio in the Nasdaq. And that is 3,000 companies listed in the Nasdaq. These are mostly your tech-heavy companies. So this is a more volatile of the three indexes. From the S&P, the Dow, the Nasdaq is going to be the more volatile, but it also offers a lot of opportunity for growth because it does hold a heavy amount of those large tech companies. And tech companies, large and small, have good opportunity for large expansion in short periods of time. Like I said, Nvidia earlier was a company about 5 years ago. It was not nearly as much of a weight in the NASDAQ as it is now. And that's only because the company expanded rapidly and expanded so rapidly that it became one of the top companies inside the index. They didn't have to go out and buy more Nvidia for that to happen and or add it into the index. The company growth itself just made that transition occur. Okay? So that's what can happen with the NASDAQ, but you can also have the opposite happen where you have those tech companies fail and go down and then they tank out, and the NASDAQ will pull back heavy with that. And we're getting in a position like that right now with the market where we have to be heavy. I mean, we have to be careful because the tech industry is now carrying the market overall. The NASDAQ, S&P, and Dow are pretty much being carried by tech companies. So if there's any kind of hiccup inside of AI or technology, we're going to have a major pullback in the market. And that is looking like there's some potential for that within the next, I would say, next year. While the data centers are being built, there's going to be a little gap between production and requested production. So you're going to have a lot of things being pushed back and delayed because they just don't have the capability of building out or producing that much that quickly just yet, until those data centers and infrastructure is all built out surrounding AI. So keep your eye out for the NASDAQ. That's a little gem right there for my people who are actually active in the market right now. But then you have global specific indexes. You don't have to focus too much on these if you're a beginner. I want you to stay focused on the S&P, NASDAQ, and Dow. You can also look at the Russell 2000. Those are small cap companies that tend to have a lot of room for growth as well. That's even more volatile than the NASDAQ. So you have volatility. I would say you got the Dow Jones, S&P 500, NASDAQ, and then the Russell 2000. So the more risk averse you are, the lower index you could choose. You could go ahead and invest in the Russell 2000 where you can have big pops but sharp pullbacks as well. So that risk tolerance is completely up to you, your understanding of the type of person you are inside. And that's what trading does. Trading makes you do an internal deep dive on yourself. Like, am I Am I a shaky person? Am I quick to push the sell button as soon as I see my money start to go down? Am I somebody who is looking to gain maximum profit? Am I not okay with only 10%, 20% profit? Do I want more than that? You got to know the type of person you are. You got to know what you're looking for and what you're looking for out of the market. And that's going to determine your investment strategy and your percentage of success in the market. So the more risk averse you are, you may have great gains and great times or great years where your account is going up tremendously because you're being more risky than everybody else. But then you're going to have times where your portfolio is getting destroyed while everybody else is still going up in value because you're too risk averse. So we got to be careful with that. Don't get too risky in your portfolio and over leverage in any one. You see your portfolio now. If you see most of your portfolios tech companies, find something in finance or find an ETF that is not tech focused to put your money in as well, or something like gold or bonds. You know, things that we talk about in some of these slides that we got coming up that I'm going to do a review over. Using indexes as investment tools. I like people that use indexes as a benchmark. I use an index as a benchmark. I use the S&P 500. If I am outperforming the S&P 500 for the year, I consider my portfolio to be doing great. Most people do not outperform the market every year, even hedge funds. The big hedge funds out there, institutional investors, a lot of the times they're so diversified in different things and everybody thinks they have the formula figured out to have the best portfolio, right? But a lot of the times, majority of people do not outperform the S&P. So the S&P on average grows about, I'll say, 8 to 12% a year. Now, if you have some good years in S&P that's 20%, that's going to be your benchmark for that year. If you didn't make 20% that year, then the market outperformed you. So you always want to consistently be looking for what the indexes are performing like compared to your portfolio. That's a great benchmark that I like to use, especially if you're a beginner, because that keeps you from having unrealistic goals. Because sometimes as a beginner stock investor, you set these unrealistic goals like, oh, I want to turn 1,000 into 100,000 in a year, right? But if you are benchmarking your portfolio's performance to those indexes, then you're going to see like, okay, maybe a 15% year was good this year considering the market only gained 10%. And then that keeps you in the bound of realism, because it's easy to get caught in the fantasy world in the stock market and thinking you're going to come in here and make millions as soon as you jump in the stock market. That's not how the stock market works. Trust and believe. Don't believe the hype. If anybody's telling you that you're going to come in here and start making thousands of dollars as soon as you start, that's not going to be the case. And if that is the case when you first start, best believe you're going to start losing that money very quickly soon after, due to lack of understanding of the rhythm and flow of the stock market. Alright, so we're going to go ahead and move on past the major indexes. Welcome everybody in the chat. Dream Team Reen, what's going on? Tyler Reed, what's going on, y'all boys? What's up? If y'all got any questions, make sure y'all ask me some questions in the chat. I'll clarify some things for you. The next section I want to review is long-term versus short-term investing. Everybody wants to be a quick flipper in the market. They want to quick flip their money. I want to, like I said, turn 1,000 into 100,000 in a year. Everybody's looking for quick flips. But there's nothing wrong with that. You do have successful short-term investors in the market. But I always say your foundation has to be in long-term investing, because that's the foundation that when all things go wrong in short-term investing and options, anything, that long-term portfolio is going to be there to catch you and support you and allow you to recuperate and rebuild and not have to start all the way back at zero. You don't want to have to always start back at zero whenever you mess up your portfolio. I know you've seen the videos on TikTok and YouTube. People, oh my God, I blew my account again. The only way you're blowing your account is if you're trading all the money that you have in your account. You're not blowing your account if you're long-term investing in the indexes that we talked about just now, the S&P, the NASDAQ, because those indexes don't go down to zero. You're not going to blow your account. It's impossible. I'm going to say that. It's impossible to blow your account if all you're doing is buying and holding long-term shares of stocks. When you become a trader, that's when you can blow your account. And you can only blow your accounts if you're trading your entire account, which you should never be doing. That's called full porting. You never want to full port your portfolio. When you're doing that, it's either because you have very small amount of money in your account, or you're taking the large amount of money you have in your account and you're being reckless with it. And even with either way, when you have a small amount of money, I still say take that small amount of money and start building up your long-term portfolio, because it's not worth it to jump in there and then just keep blowing $300, $400 a month when you can't get anything jump started. Your portfolio will never jump start that way. Sometimes you got to take 2 years to do that, build up that long term. But it's worth it because now you have a base to build off of. But short-term traders are usually day traders. They're trading intraday, buying a stock and selling the stock within the same day. And that's usually looking at intraday charts, like 30 minute, 10 minute, 5 minutes. Some people trade off of 1 minute charts when they're doing day trading. I fall more in the category, I personally like to swing trade, which is holding contracts sometimes for most of the times for at least a week or more, when you're holding a stock or an option contract. And that swing trade could go up all the way to like a year, But you could have position trading. When you go over a year, when you get close to a year, you're getting to position trading now. You're talking about something that you're holding for weeks to months. And then long-term investing, of course, is years to decades. That's what you really want to become. You want to be someone that's holding their stocks that they have for years to decades, and not someone who's constantly day trading or only swing trading. Find a balance between these trading strategies here, and you're going to see growth in your portfolio. If you stick only to one, you're more than likely going to end up either missing out on gains, because if you're only long-term investing, you're missing out on the potential gains that you could get from the day trading and swing trading. But if you're only day trading and swing trading, then you're going to have a high percentage chance of being that person that says, I done blew my account again. You don't want to do that. All right. So we got long-term trading characteristics, short-term trading characteristics. This is, like I said, active in buying, selling for quick profits is not bad, especially when you take those profits and you parlay them into your long-term holdings, so your long-term portfolio continues to grow. But it's also not bad because if you end up blowing your short-term trading money, you still have your long-term investment portfolio there growing for you with the market until you could either build back up your short-term trading money, or you could go ahead and take some of maybe some income you're making from your long-term portfolio and put it back into the short term when you get into dividends, which we're going to talk about in a second. All right, yeah, so let's go. I think this is pretty basic. Oh, no, this is important right here. I do want to talk about the tax liabilities. So you got tax liabilities when it comes to long-term and short-term trading. These are things you got to pay attention to. Because a lot of people get into short-term trading and they think they're making all this money, and it's all great, which it is good. But Uncle Sam need his cut, all right? So you got to make sure if you're a short-term trader, especially if you're exclusively short-term trading, that you are paying attention to how much of your profit you're going to have to pay in taxes. If you're short-term trading, you're buying, selling, like we said, day trading, and you're making good profits, you could guarantee at least 20 to 30% of that profit that you made has to be put to the side for taxes. All right? I usually go into the higher end. I'll go straight to 30% and put that to the side for taxes, because you don't ever want to have a tax bill hitting you at the end of the year that you were not ready for, because you made all this money throughout the year trading and investing in options, and all that stuff was great, but now you got a tax bill at the end of the year for $20,000, and you spent all your money throughout the year, or put it right back in the market. You don't understand that money needs to be put to the side, or put in some kind of vehicle that you know that this is my tax money and I'm going to use it to pay taxes at the end of this year. You do not want to get caught in that loop of tax money or taxes piling up on you year after year, and then they're coming out there, IRS is coming to seize your shit, all right? Just keep up with your taxes. There's a lot of things that you could do to write off against your gains. You could write off losses, but you could consult your tax professional for that. But I know you have to keep a close eye on your tax liability. This is a key. A lot of people get caught up making money, but they get caught up in this part of the game here. There are a lot of potential pitfalls in the investment game if you're not privy or savvy to what you need to do with the money when you make it. It's not all about just making trades and making money. You got to know what to do with the money when you make it, how to protect the money once you make it, how to keep the money growing once you make it. In each one of those steps, there are major pitfalls where if you fall down that pitfall, it could destroy your entire portfolio. Okay. We're gonna move on to now technical analysis. I want to break down some of this with y'all. This is one of my favorite things to do, technical analysis, getting those price levels on the chart. As you see, I got the shirt here, my price levels don't lie shirt on from the Land of Culture shop. Make sure you check that shop out. I got the link live in the TikTok and in the Discord as well. You guys make sure y'all check that out, get some merchandise, support the brand. So technical analysis, like I said, this is looking at the numbers behind the company. You're looking at the numbers pretty much on the chart. This is exclusively chart-based and data-based. So you're looking at charts and data and determining based on those numbers you see in front of you on the chart or what pattern you see on the chart if a company is investable or tradable right now or not. This involves, like I said, price levels, which is my personal favorite. Identifying where you might see a support or resistance in the stock's price and marking that level off so you know this is where I need to buy or this is where I need to sell. This is one of the most powerful, one of the most powerful tools and methods of investing, especially if you're going to be an active investor. If you're going to be a long-term investor, technical analysis is good, but it's not as crucial to your investment journey as fundamental analysis is. You short-term investor, you have to know technical analysis, or even a swing trader, you have to know technical analysis. That's the only way you're going to be able to time your trades. If you don't understand how to read and engage a chart and see where you need to be putting in levels, let me give you an example of how my chart looks right here. Let me see if I can share the screen with you real quick. Alright, so this is the chart right here, right? So on this chart right here, you got the S&P 500. Now you have all these candlesticks on here. You see all this data, and this is all data and information being given to you on the chart. Every last one of these candlesticks that you see on here is data and information being provided. A story is being told through this chart, through these lines, okay? You can see recessions, you can see wars, you can see inflation, you can see fear, you can see greed, you can see all that inside of a chart, all right? And technical analysis is not going to the articles or to the news to see that, is using the chart itself to see that. And you can find certain areas where you say, oh man, look how the market tops off right here. This looks like some kind of resistance comes in. And you start finding support areas. And as you start drawing your line and doing your technical analysis, your chart starts to tell you a story. And that story starts to help you better predict what's to come next in this story. Because that's all we're all trying to do. That's what everybody in the market is trying to do. They're trying to project as best they can what is coming next in this story. Now, some people will project in 5 years. Some people will try and project only for tomorrow. Some people will try and project the next hour. Some people will try and project 50 years from now. You have to know what you're looking for, and that's going to determine what time frame you're setting your technical analysis on. Are you going to do it off a monthly chart, or you're doing long-term analysis where you're going to need far-out time frames, so you need each one of these candlesticks to represent a whole month instead of 1 day or 1 hour? Or you could be charting off of a 30-minute, where every candlestick represents 30 minutes of time. And okay, now I'm trading based off of that time frame. Now, you could find successful strategies that could work on all time frames, but you have to stay disciplined to that technical analysis and whatever that strategy may be. Okay? But that's technical analysis. Is using the chart to set things like levels. Like you say, you have levels here. I have little indicators here. You put these lines on the chart. You'll see people with a lot of lines, and you see this trend zone I have here is lines and zones. These are all technical. This is all part of technical analysis. But you have to learn these skills. Technical analysis, You have to learn how to set price levels. You have to learn how to set trend zones. You have to learn how to find support and resistance. You have to learn how to identify consolidation. These are the things that are going to help you grow your portfolio and help you not get destroyed or be so surprised when certain things happen in the stock market, okay? So keep your eye and ears out for understandings of technical analysis. I will do as much research on videos on technical analysis so you could get a deep understanding. That is the only way you're going to be successful in actively trading. Because if you're not using any kind of technical analysis, I'm not sure what you're going to be using. Some people may do short-term trading off of fundamental analysis only, but that is much more difficult to do than using the chart to tell you the story. People are much harder to predict than a chart. A chart is easier to predict than human behavior. Human behavior can seem erratic, but more times than not, it's falling within some kind of pattern or chart or rhythm. And those charts and rhythms change over time. But that's why you got to keep this updated. You keep your technical analysis updated because those rhythms and patterns change throughout time. And you don't want to get caught in one rhythm and the rhythm changes to another one on you, and now you're still you're still dancing to the last song. The DJ done changed the music and changed the song, and you still two-stepping, and people out here fist pumping now. We're on a whole different vibe, but you're still two-stepping. That's how you get left behind in the market a lot of the times. All right, so let me go ahead and put this screen back on. But technical analysis and fundamental analysis combined is really the only way that you can analyze the market. Anything else outside of that is just going to be either predictive, like you're guessing, and you're trying to see what's going to happen. You're thinking that you're going to know what's going to happen, and you're trying to guess, like I said, based off of human behavior. But we know how erratic that can be. So I say, let the charts back you up on that. All right, you know what a candlestick is. We got a candlestick here. A candlestick, this will be considered the body of the candlestick right here, where you see this green. Let me see. I don't think my cursor's showing. Why I did that? But the thick green portion of that is the candle, and then that little stem at the top, that will be considered the wick. All right, so that'll be considered the wick of your candlestick. So some candlesticks have top wicks and bottom wicks. Some don't. Oh, there we go. So there we go. So you got the top wick here, and you got a body, and then you have bottom wicks on candlesticks as well. That's usually that's the formation of a candlestick. That's how candlesticks looks. Let me move myself up here. So you got candlesticks, see that bottom area? That's the bottom wick right there. This is called a bottom wick. So you got a candle that could be burning on both ends. You got top wick and bottom wicks. That usually shows you a candle burning on both ends. But once you get a push above or below one of those wicks, it usually shows momentum in that direction. So that's some things we're going to start going over in the more advanced classes. How to identify when momentum is changing and shifting in the market, and how to follow that momentum. And based on what time frame you're trading off of, momentum changes at many different times throughout a year, throughout a day. All depends on what time frame you're looking at. So don't think that any one of these things that I'm showing you is catered for one particular style. These are things that you're going to see on all time frames and all trading styles, but these are the basics that you have to know in order to apply any of those styles or become master of any of those types of analysis. You got to know these basics. So you have trends and trend lines, which are very important. A trend type, you have an uptrend. An uptrend is going to create higher highs in the market. So when we're looking at the chart, and you pull that chart back up, you have higher highs, lower lows, lower highs and lower lows, higher highs and higher lows, lower highs and lower lows for a downtrend, and sideways is flat price movement. Okay, so when you have flat price movement, what that is going to do, that's going to what we call consolidation. That's when you're going to see a chart going sideways. Let me zoom out a little bit. Let's go. Let's go out to a weekly. Make it easier to see. So with the larger time frames, it's easier to see trends. Shorter time frames, you'll see a lot of different trends being built and then breaking, and then new ones being built and breaking. But the further out you go, the larger the time frame you go on, the easier the trend is to find and spot. So when you see a trend being formed, let me zoom in so you can see it more clearly. Right here, you can see I drew two different trend lines right here. So you see right here, this downward angle was tracing the downward trend. This is when I saw a trend coming into the market, but it was holding this downward slope and it was getting pretty steep and strong. So I wanted to measure that and keep a track of when that downtrend broke to the upside. When trends break, you'll see it. It'll start to show clearly that this direction or this angle, the top blue line of this shadowed area, we break above that, that means that downtrend is starting to break. And it broke right here on this candlestick that you see here. And it started to break, and now it's not confirmed that an uptrend is forming yet, but you want to wait like 2 or 3 candlesticks to see, and then you can see, oh man, we're in an uptrend. I waited till at least right here, and I saw, okay, we're about what? That was about like 10 weeks in. We were still holding that push up, so it was clear that we're in an uptrend. Between July 21st and April 25th, we've been in an uptrend since then. Now, when you see the trend that you're in, I'm going to teach you guys how to draw trend lines. That's going to be something we dive deeper into in the next class. But when you see a trend that you're in, you got to understand that it can be broken to the downside or upside. And that lets you know that the trend is either getting weaker or stronger. It could go down or it could start to go sideways. It doesn't necessarily have to reverse and go down. Even a trend could break, even if it starts going sideways, the market could start breaking a trend. And that's what we call consolidation. And I have a tool right here that helps you identify that. So you will draw in boxes where you see the stock price starting to go sideways. And that's how you use your trends, right? And this is all part of technical analysis. You can sit there and you can do this all day with companies and different companies, and each one will tell you a different story. Some will tell you similar stories because some stocks trade alike and trade in alignment with each other. But sometimes you'll get a brand new story when you're looking at a stock compared to what you may see on an ETF for like the S&P 500. A company may be skyrocketing on an uptrend, meanwhile the overall market is on a downtrend. Or the overall market could be on a crazy uptrend and the company that you're watching is tanking and going down, and you just can't understand why. But it may be in a downtrend, and you got to look for that downtrend to break. But we will start drawing trend lines in the in the more advanced classes. I'm gonna sit down and take more time to do that with you guys. 101 for sure. I saw somebody write something. Who wrote something? Okay. All right, let's go ahead over to some candlestick patterns. Some basic candlestick patterns that are important that I want you guys to remember. This will be on the test, so write this down. These are designs or particular ways a single candlestick to look. So this is not a formation of a, let's say, cup and handle. You'll hear forms like cup and handle, all these kind of things. This is not one of those. This is just one candlestick. One candlestick can be in one of these 4 shapes. All right, so you can have a candlestick that represents a doji, which is indecision. Potential reversal could be coming in either direction. More likely in the opposite direction of wherever it was going before that doji. So if you was going up and then you have a doji candle, there's a good chance that the market will start to come down because that's indecision at that price. Is most likely then people are not interested in buying anymore and are starting to sell, or they're not selling anymore and they're starting to buy. Hammer is a bullish reversal signal at the bottom of a downtrend. So you'll see a hammer when you'll see we'll see a candlestick go down, and then you'll see a very big bottom wick. Remember, you said the top wick and bottom wick. You're going to create a big bottom wick on a hammer. I'm going to give you an example of each of these in a second. And the shooting star is the complete opposite of a hammer. It's just like an upside down hammer. It's a very large top wick with the body at the bottom. And then engulfing is when You have one candlestick engulfed by the one that comes up right next to it. If you had a downward candlestick, the very next candlestick next to it is an upward candlestick the same size. So it just engulfs it, just eats it up. But let me show you guys an example of each one of these candlesticks right now. You can see what I'm talking about. So let's identify go on a daily. It's not easy to find all these on a daily. Yeah, much easier. I think in the last week we had all these happen. It was a crazy choppy week. So an example of a doji candle would be this candlestick right here on October 6th. You'll see that it has, you almost can't even see a candlestick there because it has no body. You see how these candlesticks have body to them? The big blocks of area. This one has no body because it's only a wick. It's only a top wick and bottom wick. The body is so thin. It's because the price essentially went nowhere from open. It didn't successfully go up. It didn't successfully go down. It literally went nowhere. And that's that indecisive doji candle. So the market was in the uptrend on the daily before this candle hit, right? So now this shows you indecision is starting to come in. Like I said, based on the time frame you're looking at, the next candle that reacts after that is going to be different. So I think more times than not on the weekly, like I said, you'll see a doji and you'll see either break into the upside or downside after that. This being a 3-bar shows more indecision. This shows that it went above the previous candlestick's high and below the previous candlestick's low. But what you had similarly happen right here is called an engulfing candle. So you see how we had this 3 or this purple. Let me change this because it might be confusing. Let me turn the strat off for you right now. So you got this green candlestick right here, right? And we pushed up, closed the day up here, and then the next day we came right back down, all the way down through the bottom of it, and pretty much we almost engulfed. But the only reason why I wouldn't call this engulfing because we didn't close down here where the bottom of this candlestick was. This candlestick was more of an engulfing candlestick to this one. So we have this candlestick here. Oh shit. Yeah, you had this candlestick here was engulfed by this candlestick here. And then what you could do to see that as well, you'll see the range on this, right? You can see the price range on this. The high of this candlestick was $673. The low was $667. In order to engulf, we closed down here the day before. We closed down there $667, right? For the next day to engulf, we would have to get above this day's high. So the high of this day was 673. The next day, the high was 673.20. So that means we officially broke the previous day's high after opening up near that low. So we engulfed it and absorbed it right back to the upside. So that's what you would call an engulfing candlestick. There's some cleaner examples of some out here. Like you'll see another engulfing right here when we pushed up. The next day, it pushed right back down. And it came down and pretty much met the bottom of this candlestick right here. So it fully engulfed it. These candlesticks are pretty much the same size. And they show a reversal in momentum. So we were going up, engulfed down, shows reversal to the downside of momentum. If you get an engulfing candlestick up, that's the reversal to the upside of momentum. And you're going to look for those things in combination with your trend lines and price levels, and it's going to give you a better idea of where the market's going. Like I said, there's no exact science. Nobody has the exact answer. If somebody did, they'll be making billions and billions and trillions of dollars a year with no problem. But nobody has the exact formula or answer. So we use these tools of analysis to help us get as close as possible. Let me go ahead and switch the screen back. Make sure if y'all got any questions, you ask your questions. Let me know. Let me show you the hammer and the shooting star. Those are the two I forgot. I'm like, which one am I forgetting? So you have the hammer. The hammer candlestick, like we said, is going to be a bullish reversal. So this is going to be a day that looks like it was going down but ended up closing higher. So you see a hammer over here, and literally looks like a hammer. So this candlestick right here is exactly what it looks like. It's like a hammer. So you have a big bottom wick right here. Big bottom wick on the bottom of that candlestick, and it closed up here. So that means we came all the way down here at some point during that day. The price came all the way down to 632 from up near 639. Came all the way down to 632, but we ended up closing the day at 638. So yeah, we tried to go down to 632, but it shows that it didn't hold. And we bounced back up, showing you that there's some kind of support coming in right here at that 632. And you see the next day, it tried to come down there again, but that same support came in and saved the stock from going down. And then what happens is that the support keeps coming in often and frequently, you have that push up. Now you have the opposite, where you have a shooting star. Let's find that shooting star. I feel like we must have had one pretty recent. So we have a shooting star over here where you have this high top wick on the candlestick, and then the body's at the bottom right here. So that high top wick lets you know we tried to push up. The high of that was 672, but we ended up closing this candlestick at 669. We weren't able to close up at 672. We closed all the way down here. Let you know there's some kind of resistance coming in the market up here at this level right here, period. And that would have been the early signal to let you know that resistance at around 671 is very likely on SPY, because we put in that first shooting star as soon as we got up there. Now we kept pushing and we kept trying that area. You'll see we had a shooting star followed by a doji, more indecision, but it kept pushing up, chugging away, and then we had this big drop off right here. So it was like the warnings coming in, little warning signs. The market usually does give you some warnings on some time frame before it takes some kind of rapid drop off or crazy push up. So that's what this analysis does. Technical analysis is going to help you see those warning signs before they hit the market in full force. But yeah, right here this is shooting star, and then we identified the hammer. Those are the star, those are the different candlesticks. So you had the doji, shooting star, and hammer. Those are the main ones I want you to focus on, and the engulfing. Those are the four patterns you're going to focus on: shooting star, hammer, engulfing, and doji candle. So make sure you lock those four into your memory, and look for those patterns when you're trading. Like I said, those are one candlestick patterns. There are patterns out here where you got to see certain flows on the chart. It will show you different and larger patterns that people have learned to identify in the market over years that seem to work. But those are not the ones we're focused on right now, and keep it basic. This is just the beginners. Don't want to overwhelm you with too many different patterns and levels and charts and all this. So for right now, just focus on these four, and that'll be good enough. And last but not least, oh no, not last, I'm sorry. We're going to go over the fundamental analysis, okay? So we got fundamental. We did technical. Like I told you, if you're an everyday trader, you want to jump in on that technical analysis. But my long-term investors, you have to do fundamental analysis. It's just as important to you as technical analysis is to a short-term investor or trader. Fundamental analysis, you got to dig deep into the company and looking at its reports. This is looking at reports. You're looking at earnings reports. You're looking at balance sheets. You're looking at price to earning ratios. You're looking at ratios. You're looking at many different things that are not on the chart, but tells you about the internal health of a company and how well it's performing. You know, because sometimes a company could do so well marketing and selling itself to the public that the stock price goes up, but internally they still haven't accomplished a lot of what they are pushing and selling to the public. So when those two things aren't matching up for too long, the stock is bound to crash, because your fundamentals have to catch up to your technical at some point, or your price is too far ahead of your actual earnings. And that's why you got price to earnings ratio as one of the things you check out. When that gets too far expanded, or that gap gets too wide, a company is more likely to crash, or they must have some crazy innovation coming out that's going to help them cover that gap. And a lot of times, even when they do come out that innovation, it doesn't push the stock price up crazy because it's already obviously priced into the stock price, which is why the price to earnings gap is so wide. But three core financial statements you gotta look at. You gotta look at the income statement. You gotta look at the balance sheet, and you're gonna look at the cash flow statement. Income statement, balance sheet, and cash flow statement. My TradingView users, you should be able to find that on TradingView. I'm gonna show you where to go find that at right now. This thing will hurry up. So let's pick a company. Let's say we're looking at NVIDIA. When you open up this side chart right here, you see right here, you can click on the company, NVIDIA. It has a little pop out right there. You want to click on that. It's going to open up a tab. It's going to give you all the fundamental analysis breakdown and technical analysis breakdown that you could want to do on this one company, NVIDIA. So once you have this screen open, you're going to go to financials because that's what we're looking at. We want to look at their financials. And then we're looking at what? We're looking at the statements. So you're going to click right here on statements. And down here you see those three statements I'm talking about. The income statement, the balance sheet, and the cash flow. These are the three statements you want to check in on a company to see how they're doing internally. Excuse me. Things you want to check for when you come in here. You want to look for net income. Net income is one of the things you want to look for. You want to see that number going up year over year or quarter over quarter for a company. You want to see that number getting larger and larger. That's a sign of a healthy company. When you look at a balance sheet, the place you want to look at is net debt. You want to see a company that this number is negative. The more negative this number, the better. So that means that they have enough cash to pay off their debt. You know, they have more than enough cash to pay off their debt. That's what you want to see. And when you see this number very high, that means that they have more liabilities than assets. They have more liabilities than assets and equity. When you have more equity and assets than liabilities, you're going to have less net debt. And you want to see a company that is carrying no debt, preferably little debt, if debt is necessary in the industry, like banking is sometimes, it's necessary to carry debt. So you want to see that level be low, or you want to see it negative, where they have much more assets and money than they do debt. Because you don't want a company that could be drowned in debt anytime. And then you got this cash flow statement right here. You're looking at cash flow. Cash flow from operating activities is cool, important, but you want to look at free cash flow here at the bottom. That's the most important number you want to see. You want to see free cash flow growing year over year. Now, if you see a drop in free cash flow, as a long-term investor, you want to know why that drop came. Was there some major investment made by the company? Did they buy another company? Did they, put a big chunk of money into some kind of new form of technology? You got to know what happened there. If not, you got to dig in and do your research. And that's where these statements help you to see and identify certain things like, oh, that's a red flag. Let me go research why this number is so much lower than previous quarters. But you're only going to find that when you do fundamental analysis. You'll find some things on the chart with technical analysis, but it won't give you the meat and bones of the story. It'll just give you the chart story. It'll just show you the levels, but it's not going to tell you why. The fundamental analysis is the why. It's going to give you the deep why onto why a company is moving a specific way, whether it's going up or down. All right, so let's go ahead back. Pull up this. All right. So those are your three core financial statements. And we're going to move on after you do that. That's part of your fundamental analysis. And as a beginner, that's really what I want you to lock in on and focus is on those financial statements. And as time goes on, as you get more advanced, you can start looking at things like the ratios, the current ratio and different ratios, the price to earnings ratio, things like that matter. But when you're just starting, I want you to focus on those three balance sheets. You got the balance sheet, cash flow, income statement. I want you to focus on those three to start. And as we get into the next lessons, I'll teach you how to analyze those and compare and combine that with the ratios to see how healthy a company is. And then one of my favorite things, last but not least, is dividend and passive income. Dividends. Dividends are a powerful, powerful tool in the investment world. They're not the most attractive, especially to new investors, because they take time to build up and time to actually be paying you some respectable dividend payments. It takes a large upfront investment to get a decent amount of dividend and payments on a monthly or quarterly basis. But what you're getting in dividend investing companies is you're getting, most of the time, not all the time, most of the time, you're getting more security, stability in the investment, and you're getting income, monthly or quarterly income. And most investments in the stock market do not provide income. These are tech companies that they say, listen, when we grow and our percentage, however we grow, you take that profit and you spend that. That's your income. We're not paying you every 3 months or every quarter. Companies typically start to pay dividends when they don't see themselves expanding or growing that much more from where they are. So they use the dividends to attract people to keep investing in the company, or they run a very cash flow heavy business, like you have people that have real estate investment trusts. So they got REITs, REITs. They own properties, or they own malls, and they collect rent every month from different stores and vendors, and they pretty much use the money from the investors to help acquire more and more of these properties and land. So in order to keep the investors happy and keep their money flowing in and keep them keeping their money in, they give them a payment every 3 months of a certain amount or a certain percentage of the income they put in there, But those REITs, they pay out, they don't hold on to much money. They use your money to invest, and then they make their money off of the investment that they made, and they give you a percentage of the money they make off that investment. But they're pretty much using your money to acquire investments, and which is why they give a lot of that money back to you, because without you, they wouldn't be able to acquire these investments. So you have cash dividends. These cash dividends pay dividends directly to you. Stock dividends. Some companies pay you in stocks. They give you extra shares instead of cash. Or you could do dividend reinvestment, where you take the cash dividend that you get paid and reinvest it right back into the company and get more shares. So that's a way to do that. And then you have some companies that do special dividends, like one-time large payments. Maybe they do dividends once a year, and they'll give you some combination of cash or stock investment or stock appreciation at the end of the year. You got to know what the dividend yield on a company is. So when you see dividend yields, if you see a company with a dividend yield over like 40-50%, that's a ridiculously high dividend yield. You know that's pretty much unsustainable. There are not companies out there who are paying you 50% dividends and are still able to sustain themselves and operate and pay the employees and everything. So usually when you see high dividend rates like that, it's to attract people in. The company's really young, they need a lot of money, so that high dividend yield is something they'll potentially do for a short period of time to attract the capital. But once they get a certain amount of, of their operation into effect, the price of the stock itself will start to rise, and the dividend payment percentage will start to go down. So be careful of those too good to be true yields. A lot of that's going on out there, where you have these really high dividend yields being promised, and people aren't doing research on the companies to see how long they've been around, how consistently they've been paying dividends, and to see if what they're even promising is something that is sustainable for more than 2-3 years or 4 or 5 years, So if it shows sustainability and consistency and the yield is good, then that may be worth something to check out. But dividends are powerful too. Income, any way you can develop more streams of income is something you want to do. So this is one of the ways to do it through stock investing, is dividends. Okay? So you want to look at the dividend payout ratio. You want to make sure that the dividend payout ratio, like I said, 30-60% is okay. But once you get over 50-60% and gets higher than that, that's not really healthy payout ratio. That means the company is paying either close to exactly what it earns, or you got companies that shown over 100% in dividend payout ratio, and that's paying out more than they earn, which you could figure out how long that could last before a company crumbles. They're going to pay you out more than they earn. Let's look. There are safe ways to build dividend income. You got things out there, like I said, you got safe companies like Coca-Cola, You got Johnson and Johnson, Procter and Gamble. You got ETFs out there that pay dividends, like a JEPI, or they even got variations of SPY that pay dividends. So you could go one of those routes, and then usually the safer you go, like when you get dividends from SPY or something like JEPI or Coca-Cola, your dividend payout ratio is going to be low. But you're getting safety and you're getting income. This is a tool that can be used for people who have large amounts of money that want to keep their money safe and also be making income off of their money without having to work. So this is a good tool to start building up as a retirement tool. Don't wait till you retire to start building a dividend portfolio. You start building your dividend portfolio now, so that by the time you retire, this is a position that's paying you enough income where you could pay some bills with that income, or even go on some vacations, or pay your overhead with that income, and then you're living for free, and your dividends are covering your living expenses. That's the goal you want to look at. So that's how you could look at this as some form of retirement income instead of just some kind of small amount that's building up slowly, some small dividend, or you looking for those 100% dividends that's paying out some crazy ratio where you could double your money in a year. Don't think like that. Think about long term, and think about this is a tool that's going to allow you to live with less debt over your head in the next 10 years to 15 years, not 2 years. This is like a 10 to 15 year plan when you talk about dividends. And what you could do is you could find out those payout ratios, and I like to see how much would I have to invest in this company for the payout ratio to cover my daily overhead expenses or my monthly expenses. When you figure out that ratio, you can say, okay, I need to put this much money in the stock, and I'm gonna get paid out this percentage, and that will cover my monthly overhead. Then you have a number. Now you have a goal. Now you have a goal in mind of how much you got to invest in dividends in order to get enough money payment and enough payments in dividends to cover your monthly, weekly, daily expenses, or your vacations, whatever you needed to cover, or other investments. I would prefer. All right, but that is the review I have for you all. That is part 2 of the section 1 review. I want to thank everybody that came through the TikTok session. I will be posting this on the YouTube channel so you could catch it and get your studying on. We will be starting section 2 next week on Saturday. I'm going to put out the test for section 1 to my Discord members so you guys could take that on and make sure you are retaining the information. If you are looking to subscribe to Discord, the link is in my bio here on TikTok. Subscribe so you can get access to the assignments and quizzes and tests to make sure you are retaining the knowledge. The key is to learn and retain and execute. So let's make sure we're doing that and we're making money and expanding our wealth. And I will see you all next week for section number 2. Have a good weekend. Be safe out there. All right. Peace.